I think inflation, as you say, you mentioned it earlier on the program, that is what investors are looking at most closely, thematically. And I think the important thing to remember is that we are already seeing some signs that economies worldwide, output prices are rising, and there's a little bit of potential overheating going on as economies reopen. So the way that's been expressed in primary markets is that investors are a lot more cautious than they were earlier in the year. So, for example, spread products, so tightly priced investment grade corporates or SSAs, investors are being cautious. They're letting the issuers come to them rather than chasing the deals, and making sure that they don't over buy things that could really be impacted by a rise in rates. And similarly, on the other end of the spectrum, on the equity side, you mentioned tech earlier. Clearly, a rise in rates would have a big effect on the discount rate that you use to value long-term growth. And I think that's one of the reasons, plus regulation, that you're seeing, kind of a fall back on the tech valuation side. Where there is a real boost, though, is on the leveraged finance and high yield space. That's viewed as a product where the kind of growth that you'd get would be very much a benefit to leveraged issuers, and they have enough yield and spread in them that any sort of small moves in rates aren't really going to affect them. So we see a kind of a bifurcated new issuance market where the highlight is leveraged finance.
Really interesting to hear all those different ripple effects. And what about the SPAC market? I mean, in the US, the market has come off a little bit. When we spoke last time, we talked about the potential for the SPAC boom to come to Europe. Has this new environment that is defined by the expectation of higher inflation affecting that pipeline in Europe? And what would you say is the overall outlook in the US for SPACs?
Okay, it's a great question. And as you said, since we talked last, SPACs, particularly in the US, have come off their highs. And I think it's a healthy correction, to be honest. I mean, clearly, some of the sort of extreme valuations and kind of the optimism, in some of the SPACs, needed to be corrected. And I think that's the process which is happening now. So I think for new SPACs looking to come to the market, there is still market appetite for SPACs. But I think investors are going to be very selective on who the sponsor is and the deliverability, of the information, that's provided at the time of the business combination. And I think there's also probably an evolving regulatory scrutiny, obviously in the U.S. with the SEC, and on the listing side here in Europe, where rules are going to develop as to what exactly the disclosure regime is. Now, having said all of that, I don't think that Europe has had nearly the same kind of boom in SPACs as you've seen in the US. It's been a lot more disciplined. You see that in terms of the volumes of issuance, which have been relatively modest. And I think SPACs as a product will continue to be very attractive, both to investors and promoters, but obviously also to companies using it as a way to go public in a very efficient way. So I think SPACs are going to have their ups and downs, and it's about any investment. You need to be a selector of investments. Things can go wrong. That's why there's returns. But as a product, it's here to stay, and I think it's going to be an important part of the ecosystem.
Very clear. Henrik, I want to go back to the inflation angle that Juliana was asking you about earlier on. You mentioned that there has been less appetite to buy spread products and some of the investment grade bonds, but then there is still a lot of appetite to buy high yields. And I was interested to hear that because we've been talking to a bunch of figures from representing various European banking institutions over the last couple of days, and they're all warning about higher credit impairments to come, the possibility of a higher default rate once some of the government support and policy stimulus starts to get withdrawn. So why are investors flooding into high yields, given that it's extremely well telegraphed that you could start to see more and more of these credit impairments to come down the track?
I think that the credit support withdrawal would have an effect, I think, on certain sectors, and you're seeing that to a certain extent. Retail has obviously been tough throughout Europe and is going to continue to be tough. Commercial property the sort of future of work and hybrid working, like that, the jury's still out on what effect that will have. But I think when you look at the components now of recent issuance, it's very well diversified. Across the economy, there's tech, there's pharma, there's all sorts of sectors. And I think the fact is, going back to inflation, it's not so much that that short-term inflation causes problems for these companies. What the real question that investors are asking themselves is, what are the policy responses to a spike in inflation? And central banks and governments so far are being very clear that they are going to persevere with support, for an extended period of time. And we're really only at the stage where we're talking about withdrawing that support. And so I think investors are making the bet that over a sort of a medium-term horizon, call it a year from now, you're still going to see that stimulus, even if the economy does run pretty hot. What happens after a year from now, clearly we'll see that the situation will evolve. But for now, we're not really seeing any reduction in the demand for leveraged finance.
Well, one other major area of growth that we've witnessed over the last 12 months and actually been accelerated by the pandemic is interest in ESG investing. I'm curious to hear what the price point is for ESG type deals. Are they coming at a premium to your traditional bonds and equities, or are they coming slightly cheaper? So where are they pricing in on the general metrics?
Yeah, look, it's another great question. And unfortunately, I have to utter the slightly ugly phrase greenium, which people use to sort of talk about what the difference is between a green issuance and a brown or regular issuance. And if I take a slight step back, it used to cost money and be a hassle to issue green or ESG or SDG linked bonds. And what we've actually seen over really the last 3-4 months is, because of the explosive growth, which is a great thing for us in finance, of ESG mandates on the investor side, and a slight shortage actually of ESG type investment opportunities. It's now actually cheaper to issue green bonds than it is to issue regular bonds. So that really makes our job in convincing people that this is a good thing all the easier. We're third right now in globally in green bond issuance as a bank, and it's something that we've invested heavily in and will continue to do so, because one, it's a great business opportunity as you get a European kind of a culture of issuing SDG type bonds, and you spread that into the US and Asia, and we're at the forefront of that. But also, I think we all want to feel like we're making some contribution to climate change and society, and by leading the wave of green issuance, I think we can all feel like we're doing that.